Hi everyone, it's Jack back with another video, and today I'm going to be talking about Mercadolibre, an absolutely fantastic business, one of the best growth stories of the last 10 years. It's a business that very rarely looks cheap. It's up 78% year to date, been a fantastic performer over pretty much any time period you look at. Well off its 52-week lows, which would have been a fantastic price to get in my opinion. It's one of those businesses that's quite hard to pull the trigger on because it never ever looks cheap. Trailing PE ratio of 75, forward PE ratio is still in the 60s. It's now a $75 billion company nearly, and it's just been a fantastic performer over pretty much any time frame. It's a business that I own and I'm continuing to add to, even at these sort of prices, just because once we get into the earnings report you will see why. An absolutely stunning earnings report. First, an overview of the results, then we'll go into each of these in a bit more depth. $11.4 billion in gross merchandise volume. That was up 59% on a foreign exchange neutral basis year over year. A lot of these numbers are quoted FX neutral. This is a business that has many operations in many countries that have extreme fluctuations in their currency price compared to US dollars, but it reports in US dollars, so FX neutral doesn't always tell the full story, but I think it's the clearest picture we can get on the prospects of this business going forward. They had 357 million items sold. That was up 26% year over year. Net revenues up 69% year over year on a foreign exchange neutral basis. It's $3.8 billion. Total payment volume of the Mercadopago segment, which is arguably more attractive even than the marketplace segment, $47.3 billion. That was up 121% year over year on an FX neutral basis. And perhaps the most impressive thing and the biggest bull case for this business is the total payment volume off marketplace, so spending elsewhere other than Mercadolibre, was $35.3 billion. The majority of the spend, that was up 145% on an FX neutral basis. In a world where we're supposed to be in a recessionary environment, this growing payment volume by 145%, that is absolutely unheard of for a business this size and scale in my opinion. Their credit portfolio, which is the third wheel of this business, arguably, maybe with logistics might be the third most important segment. That was up 23% year over year. And their income from operations is growing. That was $685 million. That was up decently on the year, and an 18.2% margin, which again grew nicely, as we'll look at in a bit. As mentioned, these revenue numbers are on FX neutral basis, so that's 69% in revenue growth. That's only 40% in US dollars. Not that is anything to be sniffed at, but 69% on an FX neutral basis is obviously a lot better than 40%. You can see the quarter over quarter growth has been steadily absolutely fantastic. 61, 56, 58, 57, 69. A strong acceleration here with the holiday quarter to come. Income from operations and margin has only improved. They continue to improve their year-over-year margins. It's up 7.2 percentage points. Absolutely outstanding. They see this strong growth alongside some cost discipline as really helping their operating leverages, and they're seeing a lot of help with scale. Brazil is showing the highest profit contribution, followed by Mexico, which is the two largest markets. The net revenue per quarter has massively increased in Argentina. Argentina is actually seeing the largest amount of growth for this business. Part of that is due to inflation, obviously, but they are seeing a huge amount of growth here, and decent growth in Brazil and Mexico, which are its largest markets by far. So despite a tough backdrop in many of these markets, they're growing revenue at a really nice rate, and in tandem with that, gross merchandise volume growing at a really nice rate in the 20 and 30% in Brazil and Mexico, its two largest markets, and well over 100% in Argentina. Now in Brazil and Mexico, that is roughly in line with the items sold year over year, so you're looking at 20% year over year growth in Brazil in the most recent quarter for items sold, and 28% for gross merchandise volume. This is about what you would expect. In Argentina, there's obviously a massive disparity because of the financial problems that country is facing, but a step up in items sold, despite a really tough backdrop, is really positive. The gross merchandise volume growth in Brazil is mainly driven by increasing new buyers and those buyers buying more. So total unique buyers has just continued to grow over time. Q3 2022 was around 42.5 million. Now it's 50.3 million. And successful items per unique buyer is growing really nicely as well. That's up to 7.1. So an 18% growth in buyers year over year has really helped this business. In the interest of time, I won't speak too much on the credit and logistics side of the business. They're just nowhere near as interesting or as critical to the growth story, in my opinion, as the fintech and the marketplace business. Obviously, the logistics is hand in hand with the marketplace business, and much like Amazon, for example, they have to spend a lot of money on infrastructure, so it's kind of a cash vacuum. The credit business is just a bit boring. It's never really going to drive significant growth for this business going forward. in the same way that the marketplace and fintech side of the business is going to. And the Mercadopago, or the fintech segment, is seeing absolutely staggering triple-digit total payment volume growth and FX neutral. All geographies are accelerating, they're reaping the rewards of the investment they've put in the product development and the structural opportunities. You can see digital account total payment volume up 188.7% foreign exchange neutral basis year over year, and total payment volume for acquirers up 81.7% year over year. That is absolutely ridiculous. Total fintech users, they increased by almost 3.5 million users sequentially. Now it's getting to the point where in many countries in Latin America, this is a name brand. So eventually there is going to come a saturation point. There is going to come a point where this growth will slow down. That doesn't seem to be the case going forward. User growth accelerated over time, and wallet payers and unique fintech active users both accelerated throughout the year at a decent rate. Businesses that are growing this fast are not typically expected to be generating meaningful profits, at least on a consistent basis. Mercadolibre is doing this, and not only is it producing consistent profits and consistent free cash flow, it's actually expanding its margins. Its margins are already excellent for this type of business, but it's actually expanded them. The margins expanded 295 basis points from just over 50% to now 53% gross profit margin in Q3 2023, and this seems to be happening over a consistent basis, moving up higher. They saw dilution of customer experience costs, higher volumes to their acquirer, and gains from lower points of sales, device sales, and better first-party product margins. This is all jargon, really. They're seeing better efficiencies and better movements with scale. This is absolutely excellent for the business going forward. Also outrageous, in my opinion, not only increasing the gross margin by 300 basis points nearly, but they actually doubled their net income margin almost from 4.8% to 9.5%. Higher interest income has helped. So for people holding cash in Mercadopago wallets, definitely helped, and that was about 2.7% of the net income margin. But there was still other contributors. The OPEX was 4.3%, so while they lost 3.7% in foreign exchange, which could have made this even better, this is absolutely staggering result in my opinion. Valuation for any business like this, in my opinion, is really difficult. When they're growing like a weed but not producing amazing profitability numbers, it's very hard to value, and this is a stock that very, very rarely looks cheap. Perhaps in early 2022, they looked cheap after the general growth stock crash at the end of 2021 and through some 2022. However, right now, I think it's actually quite a nice opportunity. It's currently trading at a price to cash flow of around 15, price forward earnings of 68. Definitely does not make it look cheap. But when you consider the growth it's experiencing, that gives it a PEG ratio around 1.7. This is not an overly expensive business, in my opinion. It's definitely not cheap, and there is definitely some execution risk here. If the growth suddenly starts falling through the floor for whatever reason, I can't see that happening personally, as all we're seeing is acceleration on all fronts and excellent execution. But if the growth slows down, a business trading at this high of a multiple is going to struggle. But if you look at the multiple evolution from 2017 to now, compare the current multiples with the 5-year averages, it's staggeringly much lower. So price to book value is essentially meaningless for this sort of business, in my opinion. Price to cash flow has only came down since 2020, or well, since 2021, now sitting around 15. Price to earnings, they only really started to become consistently profitable in 2021. That has came down, halved from 2022 to 2023. They're looking at going down even further. It's not going to be long before this business, in my opinion, is getting into the price forward earnings ratios of under 40. Again, still not cheap for a conventional business, but this is a business that's growing 50%, grew 40% in dollars and 69% FX neutral revenues. That is absolutely ridiculous. It's a really high gross margin, and it has effectively an unlimited runway in Latin America as the larger region grows with it. So obviously, as I think I've conveyed during this video, I think this is an absolutely excellent business and a really good growth stock opportunity. I've been purchasing at the 52-week low, been purchasing about in the middle, I'm purchasing just off the highs. I'll probably be adding more on any dips, and I'm not too averse to averaging down a bit and paying at this price, even though I think I could probably get it for a bit cheaper. I just think this is a fantastic business. I don't think I'll be so concerned about the price I'm paying now when there's a much larger business in the future. And it's kind of, risk profile wise, it is a riskier investment than some of my other investments, but I think I can accept that given portfolio weightings. Of course, this is just my opinion. You should let me know your opinion down in the comments down below. I'm not a financial advisor, so you shouldn't take any of this as financial advice. You should do your own research and due diligence, and remember, your capital is always at risk when investing. like and subscribe if you enjoyed the video. I'll see you next time.